Mark Oswald, Chief Economist and Global Strategist, ADM Investor Services. Mark, good morning and thank you so much for joining us.
Hello.
Well, this is pretty interesting morning. I'd like to start, of course, with the economic data here are coming, and then we're going to move to, of course, the earnings reports. What are the retail sales suggesting for the U.S. economy?
Well, on the face of it, obviously, people are just going to go look at the surface numbers, which is what generally happens, and say, well, these are much, much better than expected, because they are. And the results are definitely, without a shadow of a doubt, encouraging, until, of course, one starts to think about the fact that US retail sales are a value number, not a volume number. A lot of countries, they're volume numbers. So a lot of the increase that we've got, and particularly the much better than expected outcome in terms of headline retail sales, which didn't get the sort of drag from auto sales that was expected, that the bulk of there was a 0.5% increase in auto sales, and the bulk of that is seasonal adjustment. That's definitely played a factor because it's typically quite weak in September. And secondly, is also the fact that new auto prices, we spoke a lot about earlier in the year about used auto prices, are actually going up very, very rapidly. So if we adjust these for inflation, I'm afraid to say that the result is not nearly as encouraging, and that obviously needs to be considered in terms of private consumption contribution to Q3 GDP. So it's a little bit more lateral thinking is required here, because it is a lot of this good number is actually not that good at all.
I was wondering, can we though conclude that the U.S. economy is still extremely resilient?
I think, we've got the New York Fed Manufacturing Index. As much as the New York region isn't that representative of overall U.S. manufacturing, that 19.8 level is still very solid level of manufacturing output, and it should be. The fact of the matter is, yes, there are supply chain bottlenecks. Yes, they are having an impact in terms of output. You're seeing it above all in terms of the auto sector, most notably, but it's not just there. But also order backlogs are still building, and so people actually have very full order books going forward. And in a certain sense, I think that's quite a good thing, because if we can have a smoother increase in production rather than one which is going to be just one ginormous spike, and then we start seeing things tailing off and everyone gets very worried that we're going to hit a recession. Because of the supply chain disruptions, a more managed increase in output is probably a better thing than a big boom which fizzles out quite quickly.
On the other side, I just wanted to have a very quick check on the banking stocks here on Wall Street. 1.70% when it comes to Goldman Sachs. By the way, beating expectations once again. I just wanted to go into the numbers, go through the numbers very quickly. Earnings of $14.93 a share versus $10.18 consensus estimate. Then revenue $13.61 billion versus $11.68 billion consensus estimate. And the keys where trading makes up a bigger slice of revenues than in its big bank peers. This is what matters for Goldman Sachs at this point. Certainly, we're going to see more details in a while from the CEO, David Solomon, that's for sure. But first of all, Mark, I was wondering, we also saw the numbers of JP Morgan, Bank of America, Wells Fargo, Citigroup, all above expectations. This is also because they relieved some funds that they shelved earlier, 1 year ago, I guess, or a little more, because of possible bad loans. I was wondering, what are these key banks' earnings suggesting for the U.S. economy as well?
I think they're overall positive. I think they've probably done somewhat better on the trading side, which in no small part is because we've seen a bit more volatility in Q3. So as much as we've tailed off somewhat in terms of where the equity indices have been going, volatility is good for these big money center trading banks with their big trading arms. Also seeing more encouraging signs. Particularly, I think we saw that with the JP Morgan results and some of the regional banks, in terms of loan demand, because one of the concerns, I think, above all in Q2, was that loan demand was dropping off, and that was suggesting that basically at some point the US economy was going to that basic concerns about the US economic outlook was encouraging companies not to borrow money to basically expand their businesses going forward. So if we see a bit of pickup in loan demand, that's certainly no bad thing. There are still plenty of hurdles, and one of them is obviously all related to, are we going to get the extra fiscal stimulus that everyone was celebrating earlier in the year, or is it just going to get stuck in Congress for a very protracted period?
On the other side, when it comes to of course, their desire, the consumer's desire to get loans, do you think this is a focal point for the banking sector?
I think the desire, the current point, I think, for consumers really is actually how they manage their finances given the inflation pressures that we've got. For some, obviously, we're seeing some low-end upward pressure on wages due to staff shortages, and that obviously the inflation then becomes less of an issue. But for others, we've got a lot of non-discretionary inflation pressure. When I talk about non-discretionary inflation pressure, I'm basically talking about the three key areas. Rents are going up very sharply in the US, food prices going up, and energy prices, both household energy and indeed gasoline prices. And to some extent, that obviously impinges on consumers' ability to allocate money to basically maybe borrow some money to improve their homes, etc. So there are sort of two factors at work here, but the fact that things are bottoming out in terms of demand is encouraging, and it does suggest that above all a strengthening labour market after the pandemic shock is very much a real factor, and that perhaps the monthly data that we get in terms of payrolls are not really telling us the whole story in terms of how strong the labour demand actually is.
When it comes to the macro data, I just want to take a step back and ask you how important is the Fed reaction on inflation data? Because what we saw this week on Wednesday is that actually inflation is here to stay. It looks like more structural inflation rather than temporary inflation. So do you think that they are 100% supposed to react on what we saw on Wednesday?
Well, I think they don't want to react. I think this is the more important thing. They still want to stick to this. Well, it's transitory, but the transitory pit is going to last a lot longer than we initially thought, and that could have potential risks. But we don't think they're going to materialize. They really don't want to tighten policy aggressively. I mean, I think that's really the clear message. And I think the risk remains is that the pressures that are there, and they're caught in a very, very difficult place, because a lot of the things where we're seeing inflationary pressure, and that inflationary pressure, I have to stress, has changed in recent months. What was causing inflation in this week's report is far more structural issues. Energy, we know there's an energy crisis really around the world. We focus on the European one and the one in China, but there are problems in India, there's problems in Brazil, there's problems in the US as well. It's food. A rate hike isn't going to actually, going to the point of a rate hike isn't actually going to change any of that. These are structural issues, and they're much more to be dealt with by governments. And even then, that's a big challenge, because you may be either putting in subsidies in place or incentives in place, which are costly in terms of subsidies, or incentives which are market distorting. So there's a great deal of care needed to be dealt with this, and And the real key factor for the Fed, obviously, is going to be, well, how much of that is now going to spill over into secondary effects? The most important one is how much is it going to spill over into widespread wage increases? At the moment, the jury's out on that, and particularly the wage data is still heavily distorted by base effects. So it's actually very difficult to make up one's mind on that. And that's where their intelligence in terms of talking to businesses is actually going to be very, very important.
Yeah, that's for sure. And certainly, at least for the banks, higher rates are going to be very, very fruitful, if we can use this word. I was wondering, final take, Mark, on the dollar index, which we saw pretty interesting movements in the past few days. Once again, we do see the dollar index below the 94 mark at 93.97, off about 0.01% right after the retail sales and the data that we saw. So I was wondering, I know it's extremely difficult to forecast any movements for the dollar index since it's very sensitive on many topics, but what are your expectations at least until the end of the year, which supposedly is going to be the very beginning of the tapering?
Yes, well, I mean, I think the dollar index has had a bit of a setback because markets were looking at the inflation numbers and all the raw material price increases and saying, well, at some point all these central banks are probably going to be forced to throw in the towel. Then they heard the Fed's narratives from the FOMC minutes, and this very strong message that they don't want to really react to what are structural pressures, and they do believe that they will pass, basically meant people saying, well, they're just not keen to press the trigger. So to some extent that undermines the dollar, to a limited extent. On the other hand, it doesn't really, in the sense that we're still basically seeing a US economy which is reasonably robust. The Fed is still going to be probably at the forefront relative to, above all, the euro and indeed the yen in terms of removing a monetary accommodation. The Bank of Japan has very clearly stated this week there is no, we can't walk away from any of our unconventional monetary policy measures, and the ECB is definitely clearly a very, very long way from even considering that. So the Fed will be ahead of them, and that in itself is dollar supportive.
Thank you very much, Mark Oswald, Chief Economist and Global Strategist, ADM Investor Services. Thank you for joining us, and have a great weekend.
Thank you.